The modern digital economy runs on two parallel engines. First, a decentralized settlement layer that coordinates global value. Second, the massive physical compute layer required to actually process and power those interactions. For years, BitDigital operated as a traditional pure-play Bitcoin miner. But recently, they orchestrated an aggressive corporate pivot to capture both of these engines simultaneously, rebranding themselves as a strategic asset company. On the surface, the bull case for this new model is compelling. The company accumulated a massive Ethereum treasury to capture network yields, and they acquired a 70.4% majority stake in WhiteFiber, a provider of high-performance AI cloud computing infrastructure. This table outlines the exact paper value of these holdings. Between Ethereum and WhiteFiber equity, BitDigital claims $888 million in assets. Yet the stock trades near $1.80, creating a massive 31% discount to their stated net asset value. Institutional investors are not blind to an $888 million balance sheet. They are actively penalizing the stock because they perceive an existential structural risk in the mechanics of how this new company actually operates. To understand that risk, we have to look at how BitDigital dismantled its original business model. They intentionally wound down their legacy Bitcoin mining fleet, reducing their active hash rate to a residual 1.5 exahashes per second. Looking at this strategic timeline, the exact shift in capital allocation becomes clear. By 2025, the focus fully transitions away from Bitcoin, moving aggressively into infrastructure scale and strategic positioning within the Ethereum ecosystem. They funneled their remaining mining proceeds into a new treasury layer. The company accumulated over 150,000 ETH, dedicating almost 90% of it exclusively to native staking to generate protocol-level yield. Simultaneously, they built out their physical compute layer. They acquired the controlling stake in WhiteFiber to construct and operate Tier 3 data centers for generative AI workloads. This pivot replaced the predictable, albeit volatile, cash flow mechanics of a pure-play crypto miner with the immense upfront capital demands of heavy infrastructure development. The immediate financial strain of this transition surfaced in their first quarter 2026 earnings. Total revenue dropped 13.6%, and the company reported a staggering net loss of $146.7 million. The core driver of that loss exposes a severe vulnerability on their balance sheet. It all comes down to the high cost basis of their Ethereum acquisitions. BitDigital acquired their ETH at an average price of $3,045. By Q1 close, Ethereum fell to roughly $2,104. This underwater treasury severely restricts options. They cannot liquidate ETH without realizing massive losses, reflected directly in that $146.7 million net loss. To maintain treasury flexibility without selling at a loss, management executed an emergency maneuver. They repositioned 70,000 natively staked ETH into liquid staking tokens. The premise of a stable, yield-generating Ethereum treasury relies on price stability. When market volatility strikes, that core asset transforms into a liquidity trap, choking off cash. That lack of liquidity collided with the realities of the AI compute market. Building sovereign-grade AI infrastructure requires staggering physical resources and intense capital expenditure. WhiteFiber did secure a major commercial victory, a 10-year co-location agreement for their North Carolina facility, representing $865 million in contracted revenue. The catch is the immediate financial obligation attached to that contract. Fulfilling it requires purchasing the NC1 site for $45 million, followed by the immense cost of upgrading the facility to Tier 3 hyperscaler standards. The math here is unforgiving. BitDigital's residual Bitcoin mining revenue, combined with the yield from their trapped Ethereum treasury, is entirely insufficient to cover this level of capital expenditure. Because BitDigital holds a 70.4% ownership stake, WhiteFiber's financials are fully consolidated. Every dollar of that infrastructure expense is transferred directly onto the parent company's balance sheet. The AI data center pivot secures highly lucrative revenue targets for the next decade, but it forces a devastating immediate cash burn rate today. Facing a massive CapEx deficit and an illiquid treasury, Corporate finance engineered an aggressive, multi-tiered debt stack to bridge the gap. The capital stack's foundation is a $135 million block of convertible notes. They compounded this with a $100 million Galaxy Digital loan, carrying a 9.5% interest rate and a 3% discount. Crucially, a 1.1x minimum multiple on invested capital repayment dictates returning $1.10 for every dollar drawn. Sitting directly beneath that is the downstream threat of the convertible notes. Depending on the stock price, those notes guarantee either massive future equity dilution or a crippling cash repayment. This debt structure is a ticking clock. If cash flows from the NC1 data center are delayed by even a fraction of a quarter, these covenants will trigger a severe corporate liquidity crisis. An underwater Ethereum treasury paired with a highly punitive debt stack explains the intense short interest and bearish outlook from market analysts. In the capital-intensive mining and infrastructure sector, relative financial strength dictates survival. Digital's smaller market capitalization leaves it with zero buffer against broader crypto market swings compared to its larger peers. Institutional investors have applied a 31% distress risk premium to the net asset value, pricing in the structural dangers. That premium is derived from three exact inputs: impending share dilution, the brutal cost of debt servicing, and execution risk in data center delays. This heavy discount represents a precise calculation by the market, weighing the specific risks of bankruptcy and shareholder dilution against the raw value of the underlying assets. Digital has engineered its operations into a state with a razor-thin margin for error. For the bull case to survive, Ethereum prices must aggressively recover past the $3,045 cost basis, and WhiteFiber must hit its Phase 1 deployment targets in North Carolina flawlessly to trigger the interest rate step-downs on their loans. The bear case requires far less effort. Any minor construction delay or a sustained downturn in crypto prices immediately triggers the debt covenants and actively destroys remaining shareholder value. This strategic asset company model operates as a highly leveraged binary bet on perfect operational execution. Digital acquired the exact assets needed for the future of the digital economy, but the brutal, unforgiving cost of capital required to actually build that future could ultimately be their undoing.